It's Mathieu Roy. We're closing the books on Q1, and I just wanted to share some thoughts from the investment team. 2023 was eventful, many notable investment sentiment shifts, but we finished the year on a positive tone, and that excitement persisted in the first quarter of 2024. Why? Well, we have a resilient economy, and the central banks still seem to want to accommodate sooner rather than later. All of this is fed into investor optimism for all risk assets, really. The preferred one, or the best performing risk asset class, was US equities. That makes sense. There's significant technology exposure, semiconductor demand feeding into AI products that a lot of companies want to build. That helped the US equities perform the best. But Canadian equities and international equities also had strong performance for the period. In Canada, in particular, we were helped by oil, which had a nice run, climbed 15%, finished a quarter at $83 WTI. In terms of what we've been doing within the strategies, in Canada, we welcomed back Gildan Activewear. They're spending a lot of time in the news with a lot of boardroom drama as people fight for control of the company, but doesn't change the fact that they're a terrific low-cost producer, and they have been for decades now. We sold our position in 2017, and we're buying it back only a few dollars more expensive, but their profitability per share, earnings per share from the company, is almost double during that same period. So we feel we're getting a terrific investment at these levels. In the US and international, we spend a lot of time trimming a lot of those strongly performing technology companies, which they perform well. We love them, but they're getting a little more expensive. So we recycle some of those dollars into more defensive companies that we own, mainly on the consumer and healthcare side. On the US side, we also introduced a new company, United Rentals. You may be familiar with that company. We feel that the move from owning to renting still has a lot of legs, and it's still a very fragmented market. We feel that we're going to get a long period of outperformance from that business. When we look at the outlook, how we feel about investing in general, certainly just like the market, we do appreciate that we've done a lot to tame inflation. So we're feeling in a similar way as central banks are feeling, where soon enough we should be able to reduce interest rates, but we don't see the rush, because inflation is still there and the economy is still strong. So it doesn't feel like the economy needs a lot of fuel. So we could have investors being a bit disappointed. We've had markets rally significantly into that optimism. Certainly recently, those investor expectations have checked back somewhat. We think that's reasonable. We feel that the equity markets, as they stand overall, probably offer fair risk reward here. We wouldn't be overly enthusiastic to buy equities in the very near term. That being said, we feel it's a great environment for investors in general, especially if you have a midterm outlook. If you think about how we're navigating high inflation, it's coming down. We have the ability to cut rates. So if you think about equities longer term, if the economy slows, we have significant ability to cut rates across global economies. That's a positive. And in the meantime, fixed income asset classes, which haven't yielded a whole lot for the last 10, 15 years, are offering attractive interest rates to wait. So money market instruments are offering attractive returns for very low risk, and you can also lock in some of those interest rates for longer periods of time on the bond market. So we feel it's a strong environment for investing in general. Maybe the markets are a little ahead of themselves on the equity side, but in general, we feel very happy with the opportunity set for investing. Thanks for listening.